Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be joined by partner and head of macro and technical research at the firm, Chris Verrone. Chris, how are you doing this morning?
Ross, great to be here. Happy holidays.
Same to you. Good to talk to you. I kind of wanted to go big picture looking towards 2025, but I think we have to start with we're recording on Thursday morning, and yesterday, we saw one of the worst days in the market, kind of in the post-COVID era. I wondered what you made of it, any big takeaways, and does it mean anything for the 2025 outlook?
Yeah, it's a great question, and it's certainly the appropriate place to start. And what I'll do is I'll kind of walk you through what I told both our team this morning and what we've been on the phone with clients since yesterday. I'd say first and foremost, we still need to color this market through the context of an ongoing uptrend and an ongoing bull market. We don't want to lose sight of that. Upward sloping 200-day moving averages, all the things that you would expect to still see in an uptrend are largely still in place. And why that's important for us is because it tells us how to behave or how to respond when you get corrective moments or pullbacks like this. Now, I recognize that the S&P is only, let's call it 3.5% off the highs, but the equally weighted index, so the average stock is more like 7 or 8% off the highs here. So this corrective phase has been going on, I think, a little bit longer than people suspect. Some of our tactical indicators are actually starting to get a little bit more flushed here, and I don't know if it's here or if the calendar has to change, but I would still guess this, call it 5650 to maybe 5800 zone on the S&P will prove to be very good support into the first quarter of next year. Now, what I do think yesterday does do, though, it raises the bar or the threshold for what I would want to see on any rally coming out of this, right? One of the things that's been so consistent really over the last 2 years is when you've had these setbacks or corrections, you've rallied out of them with vitality, with very good breath, with very pro-cyclical leadership. So I think that'll be an important test, over the next 4, 6, 8, 12 weeks, as this market gathers itself and starts to respond. Do we get a resumption of that very pro-cyclical leadership, that good breath? I think importantly, do credit conditions remain benign? That's been a very important feature of this bull market for 2 years. I think it's important we keep those intact. So if there's an approach here, it would be number one, recognize the context. We're still in an uptrend. But second, also raise the bar for what you'd want to see coming out of this correction phase to begin to answer the question, is this going to continue for the foreseeable future, or is the market trying to tell us something's changing?
Yeah, and I think you mentioned that the headline index is not all that far off the highs, and that has really been a function of this resumption of Magnificent Seven and big tech leadership or strength or whatever you might call it. What do you make of that, versus the kind of cyclical bump that we saw post-election, and what is your sense of how that plays out into 2025?
So I certainly don't mind it in the context of if Mag 7 is reasserting itself after really a 6-month pause. A lot of these stocks didn't do a whole lot from basically call it late spring, early summer through maybe a couple of weeks ago. So I don't mind that they're getting back involved as long as it's not at the expense of everything else. And that's what I think is going to be the big question over the next 4, 6, 8 weeks here. If we start to see the rest of the market, which is now frankly pretty oversold, start to rally out of this, can it do it and kind of get back into the fold? Because we don't want to get to that environment where it's just exclusively Mag 7. That really has not been the case all year. We don't want to return to that.
Right. Well, looking to 2025, and I want to end here. If there was, and I'll put you on the spot a little bit, if there was one indicator or one benchmark that you could use to tell the story of 2025, whether it be the dollar, the 10-year, relationship in equity markets, discretionary versus staples, something like that, what is one thing that you would want to know ahead of time out of the kind of spectrum of items you could look at?
Yeah, it's a great question. And, I would think about I think about this in context of, what has been the story of the last 2 years? I think the story of the last 2 years has been the economy continuing to defy expectations and remain more resilient and firmer than people suspect. So I think the question we have as observers of markets is that likely to persist for another year? And what tools do we have to answer that question? So I'll cheat and I'll give you two things that I care about, not just one. I've always said my favorite economist on Wall Street is the relationship between consumer discretionary and consumer staples. Um, I think it's important that continues to work here, right? Because there's not a lot of people out there really thinking about a weak economy in 25 or the risk of recession, and we're certainly not in that camp either. But what could move us more in that direction if you began to see deterioration in those relationships like discretionary versus staples? That's certainly top of mind for me. I think the good news is that it's still largely okay. And then alongside of that, I would put our whole package of credit indicators. One thing that's been pretty consistent with, modest corrections that turn into something more sinister, or little hiccups in the economy that turn into more overt weakness. One of the things you tend to see in those environments is broad deterioration to the underlying credits. So we look at stuff like double B spreads or double B versus triple B or high yield CDX. I think it's very, very important that remains benign as we move through this first half of 2025 in front of us. As we think about our work and what our process is, as I always tell my team, and I'll tell the audience today, what do we focus on? Number one, first and foremost, don't lose sight of the longer term trend. Always stay within the trend. That's important for us. Number two, but equally, always be on guard for stuff that's not acting as you might expect it to be. And then third, you can be a contrarian in this business, but only if the market allows you the avenue to do so. There's no sake in this business of saying, oh, everyone's bullish, so I'll be bearish, or everyone's bearish, so I'll be bullish. You can only take those contrarian positions when the market gives you an avenue to do so. So I think that's the question we have into 25. There's certainly post-election a lot of bullishness out there. There's been animal spirits that have been reawakened. Does the market continue to live up to that expectation moving forward? So that's what's on our mind, Ross. But I think you and I have done maybe 4 or 5 of these calls this year. It's always a pleasure to do it with you and your team.
Yeah, Chris, this is a perfect capstone for the year, and we'll look forward to talking again in 2025. Thanks as always for the time. I appreciate it.
You bet.